You already own more than one kind of dividend investment, and if you are honest with yourself, you are not entirely sure which ones are safe and which ones are quietly sitting closer to a landmine. That is the exact spot most people in their 40s and 50s end up in. They bought an ETF because a video told them to, then a REIT because it paid more, then some high-yield stock because the number looked good, and nobody ever laid it out as one ladder from safest to riskiest. So here's that ladder, stated flat, right now. At the bottom, Treasury bills and money market funds paying just under 4% with the United States government standing behind every dollar. One rung up, broad dividend ETFs like SCHD and VYM. Above those, individual dividend growth stocks like Johnson & Johnson. Higher still, REITs, the real estate income sector, followed by high-yield stocks and business development companies pushing toward 10%. Above those, covered call ETFs like JEPI, paying more than 8%. And at the very top, single-name high-yielders like AGNC Investment, paying over 13%. That order is correct, and every number in it is sourced and dated, so you can check it yourself. But the order alone will get you hurt if you use it wrong, because a ranking tells you where the risk physically sits. It does not tell you how much of your own money belongs on any one rung. And that second question is the one that actually decides whether this pyramid protects you or quietly wrecks your retirement. You should not take my word for why this ranking holds up. So here is the actual mechanism behind it. Every rung on this pyramid is ranked by one question. What actually stands behind the payment when things go wrong? At the bottom, a Treasury bill is backed by the full faith and credit of the United States government, which is the strongest backstop that exists in dollar terms. As of July 14th, 2026, the 1-month bill yields 3.73%, the 3-month bill 3.84%, the 6-month bill 3.95%, and the 1-year bill 4.02%, according to the Treasury Department's daily par yield curve. Notice something odd there before we move on. The shortest maturity pays almost as much as the 1 year. That inversion is a genuine market signal, and we are coming back to it, because it tells you something about where interest rates are headed that most of this pyramid depends on. Call this the backstop test and keep it running under everything from here forward, because it is the actual mechanism deciding where a dividend investment lands, not the yield printed next to it. One rung up, broad dividend ETFs. Spread that backstop across 100 or more companies at once. SCHD, the Schwab U.S. Dividend Equity ETF, carries a 30-day SEC yield of 3.18% and an expense ratio of 0.06% as of August 13th, 2026, according to Schwab Asset Management's own fund page. VYM, Vanguard's High Dividend Yield ETF, runs a lower yield around 2.17% with an expense ratio of just 0.04%. Neither fund is backed by a government. They are backed by the combined earnings of every company inside them, which is a real backstop, just a more distributed and less absolute one than a Treasury bill. If one company in SCHD cuts its dividend, you barely feel it. If the United States government defaulted, every rung on this entire pyramid would already be on fire. That gap between one company's earnings and 100 companies' combined earnings is worth its own full breakdown. And there is a specific place to go. Get it once this video ends. For now, one rung higher, we move from a basket of companies to a single one, and the backstop test changes completely. Dividend growth stocks are backed by nothing but a single company's earnings, decade after decade, and Johnson & Johnson is the cleanest proof this pyramid has. The company raised its dividend for the 64th consecutive year in 2026, taking the quarterly payout to $1.34 a share, a 3.1% increase, announced April 14th, 2026, straight from the company's investor relations page, at a share price of $260.35 on August 14th, 2026. That works out to a yield of 2.06%, the lowest number on this entire pyramid so far. That is not a weakness. It is the price you pay for a backstop built on 64 straight years of a single company choosing to raise your payment, even through recessions, a housing crash, and a pandemic. A dividend growth stock can absolutely still cut its payout. It has simply proven 1 year at a time that it chooses not to. One rung up from that, we leave individual companies behind and move into an entire sector built around a legal requirement to pay you. And this is the rung most people misjudge the worst. REITs sit here because real estate investment trusts are legally required to distribute at least 90% of their taxable income to shareholders to keep their special tax status, which means the payout itself is closer to guaranteed than a normal company's dividend, even while the properties underneath it swing with the economy. The FTSE Nareit All Equity REITs Index carried an average dividend yield of 4.00% as of March 31, 2026, across roughly $1.4 trillion of equity REIT market value, according to Nareit's own industry fact sheet. Most people assume REITs sit above high-yield stocks on a risk ladder because the word real estate still triggers memories of 2008. It does not belong there. The 90% payout rule is a structural backstop no ordinary company has. And that is exactly why REITs sit in the middle of this pyramid instead of near the top. What actually moves REITs up or down inside this rung is which kind of real estate they own. Offices behave nothing like data centers or storage units, but as a category, the backstop is stronger than the reputation. Here is where the ladder stops being about which rung to own and starts being about how much of each one you should actually own. And that is a math problem you can solve for your own situation right now. Call it your top rung ceiling, and it works like this. Take the number of years until you actually plan to start drawing income from these investments, multiply it by 5, and cap the result at 40%. That percentage is the most your total dividend income should come from the top two rungs of this pyramid, the covered call ETFs and the single name high yielders combined. Run it at both ends so you can trust it. If you need this income starting now, 0 years out, your ceiling is 0%, meaning none of your income should be leaning on the riskiest two rungs the moment you actually need the check to clear. If you are 20 years out, the formula would technically allow 100%, which is exactly why it is capped at 40, because even with 2 decades of runway, no single mechanism should ever carry that much of your income. If you want to run this exact formula against your actual numbers instead of doing it in your head, I built it into the Catch-Up Investor Playbook, a compiled reference of the tiers and formulas from this channel, linked in the description, so you are not rewatching videos trying to find one number. That ceiling exists because of what happens on the next two rungs, where the backstop test gets genuinely uncomfortable. High-yield stocks and business development companies are backed by something much narrower. The ability of a private company you have never heard of to keep making loan payments. Ares Capital, ticker ARCC, the largest publicly traded BDC, pays a quarterly dividend of 48 cents a share against a share price of $19.87 as of August 14, 2026, a yield of 9.66%. A BDC like Ares Capital is a regulated investment company that lends directly to mid-sized private businesses at floating interest rates, and it must distribute at least 90% of its taxable income to shareholders by law, similar to a REIT. That sounds like the same strong backstop from 2 rungs down, and it partly is, but the difference is what the loans are backed by. AREIT's 90% rule sits on top of physical buildings collecting rent. A BDC's 90% rule sits on top of loans to private companies that could default. And because those loans are floating rate, the yield itself moves whenever interest rates move, which is a very different kind of income than a treasury bill locked at a fixed rate for a fixed term. That yield curve inversion from the opening minute matters again right here. Floating rate income like this rises and falls with the same short-term rates that inverted, so watching treasury yields is not busy work, it is actually tracking the ceiling on how much BDCs like Ares Capital can pay you next year. One rung above that, the backstop stops being a company's earnings entirely, and becomes something most people have never had explained to them in plain language. Covered call ETFs, like JEPI, generate their payout by selling options contracts against a stock portfolio, collecting a premium upfront in exchange for capping the upside if the stocks rally hard. JEPI's 12-month distribution rate sat at 8.06%, with a 30-day SEC yield of 8.20%, and an expense ratio of 0.35% as of June 30th, 2026, according to JP Morgan's own fund fact sheet. Almost nobody explains this part before you buy it. Option premium income is not backed by a company choosing to pay you out of growing profits, the way Johnson & Johnson's dividend is. It is backed by volatility itself, which means in a calm, steadily rising market, the premiums shrink, and the fund can end up paying you back a slice of your own original investment just to keep the distribution looking consistent. A mechanic tax analyst covering JEPI have flagged directly, since much of that income is taxed as ordinary income rather than the lower qualified dividend rate that SCHD or Johnson & Johnson income gets. That single distinction, ordinary income versus qualified income, is worth understanding before you ever compare a JEPI yield number against a REIT or an ETF yield number, because the government taxes them completely differently. And under current tax rules for 2026, qualified income stays at the 0% bracket up to $49,450 of taxable income for a single filer and $98,900 for a married couple filing jointly, according to IRS Revenue Procedure 2025-32, while ordinary income from something like JEPI stacks on top of your regular tax bracket instead. Which brings us to the top of the pyramid and the actual reason this whole thing is shaped like a pyramid instead of a straight line. AGNC Investment, a mortgage REIT, currently pays a monthly dividend of 12 cents a share against a stock price of $10.96 as of August 14, 2026, a yield of 13.14%, the highest number on this entire list. A GNC does not own buildings and does not lend to businesses. It borrows money short-term at low rates, uses that borrowed money to buy agency mortgage-backed securities that pay a slightly higher rate, and pockets the spread between the two, magnified with leverage. When that spread compresses, when short-term borrowing costs rise faster than the mortgage securities pay, the backstop underneath the entire dividend gets thinner in real time, and mortgage REITs have a long, well-documented history of cutting distributions and eroding the underlying share price even while the yield number stays eye-catching. That is the whole answer to why the ranking works the way it does, and it is also the one thing the yield number alone never tells you. The yield number is not what actually determines where an investment sits on this pyramid. The mechanism manufacturing that yield is. A government promise sits at the bottom, and a pool of 100 companies' combined earnings sits just above it. One company's decades of earned discipline sits above that, and a legal payout rule backed by physical property sits a rung higher still. That same legal payout rule, now backed by riskier private loans instead of buildings, sits above it. Volatility itself, harvested through options contracts, sits above that. And right at the top, a leveraged interest rate spread sits with nothing underneath it but the gap between two moving numbers. Two investments can carry the exact same yield and sit on completely different rungs because the yield was never the risk. The engine behind it always was. So here's the ladder again, now that you can actually see what is running underneath every rung of it. Treasury bills and money market funds backed by the government itself sit at the bottom, with broad ETFs like SCHD and VYM one rung up, backed by 100 companies' combined earnings. Dividend growth stocks like Johnson & Johnson sit above those two, carried by one company's decades of discipline, and REITs sit a rung higher, backed by a legal requirement sitting on physical property. High-yield stocks and BDCs like Ares Capital sit above the REITs, backed by that same legal requirement, only now sitting on riskier private loans instead of buildings. Covered call ETFs like JEPI sit above that, backed by volatility itself rather than earnings, and single-name high-yielders like AGNC sit at the very top, backed by a leveraged spread that can vanish overnight. You already owned pieces of more than one of these rungs before this video started. Now you know exactly what stands behind each check, which means the next time one of them gets cut, and eventually one will, you will already know why, instead of finding out the hard way at the worst possible time. Before you go, I want to know where your own money actually sits on this pyramid right now. Are you holding more of the top two rungs than your top rung ceiling would actually allow? Did any single yield number on this list surprise you once you saw what was really backing it? And is there one investment in your own portfolio you are now going to go check the mechanism behind? Put it in the comments, because I read every one of them. If you want the full breakdown of which broad ETFs sit at that second rung and how they compare fund by fund, go watch the best ETFs to live off dividends. In America, it picks up exactly where the second rung of this pyramid leaves off.